So let me proceed now to our panel discussion. And joining us are fund managers to help address some of the investor concerns. We'll talk about how it will affect particularly fixed income investments, because we will be talking to our fund managers. First is Mr. Sam Valmayor, included in the panel. He's from BPI Investment Management, Inc. He represents the group that manages the largest mutual funds in the country with over 214 billion in assets under management. And also, they manage the largest bond fund in the country. And the lead fund manager of both ALFM and PAMI Film Funds under the BPI Investment Management Inc. Sam is a veteran fixed income fund manager to give us his views later. And then also joining us together with Sam is Mr. Ritchie of Sun Life. He's the Deputy Chief Investment Officer of the group, another veteran fixed income fund manager handling the largest money market mutual fund in the country with over 116 billion. Ritchie is the head of fixed income of Sun Life Investment Management, and he is recognized as one of the most astute bond investors in the country. He oversees the fixed income strategies of Sun Life, and they now have the second largest mutual fund with over 165 billion. Welcome, gentlemen, because of supply bottlenecks. And should we be concerned about inflation?
Okay. Thanks for that question. You're right, no? Taas ng bilis ng taas. And if you look at the chart that we've prepared here, inflation really shoot up. That's why it averaged 4.5% for this year, no? But that's mainly because of supply-driven, as what Director Habito mentioned a while ago, no? It was because of the African swine flu in the first half of the year. The good news there is, if you look at the dotted chart there, the dotted line, we think that inflation will be moderating. It will go down na from here, no? That's why we are supportive also of the government's view that inflation can trend lower and average at around 4.3% from 4.5% this year. As medyo okay na with the meat imports, so there's some relief already on the supply side. That's why it can go lower. And if we want to go technical, especially for next year, no, we will be using the base of 2018. If you recall, for 2018, that's when inflation again shoot up. And if you use that as a base, so medyo high base, we can expect lower inflation numbers. And of course, from this year, since higher base also, from next year, we're more constructive since it can become lower. And our forecast would be below 4% for next year.
Good. That's good. So with the lower inflation, ano tingin mo sa interest rates? Up, downward, sideways, flat? Anong tingin mo sa interest rates ngayon? Local interest rates moving forward.
So good question. For interest rates, so it's important to look at inflation. Then we need to look at what the BSP would do, no? So on the slide here that we've prepared also, on our model, BSP policy rates will remain at current levels of 2%. Although there's some inching up on the model, but that wouldn't really warrant increases, no? So they would stay 2%. If ever they would really hike rates, like what the Fed would probably do next year, maybe that would be on the second half, no? Because there's a lot of uncertainty, as like what Director Habito highlighted, no, in his presentation. It's quite hard to restart, and they would really want to give a lot of leeway, room for the economy to pick up before they really tighten it again. And if their view is really for inflation to go lower, it's really more supply-driven, from this year, then there's really no rush to hike rates.
Galing. So you're not as concerned compared to others on inflation. So you guys are managing one of the largest fixed income. So medyo may effect yan . So bago kita paalisin, before I go to Sam, what do you think should people now do with their bond investments? Ano yung strategy natin dyan?
Okay. Yeah, for bond investments this year, I believe it's kind of flattish or slightly negative pa, it's really mainly because of higher rates, interest rates, so lower prices, no? But what's nice there is because the yield curve, I think I have a slide there also on the yield curve of the Philippines, wherein we saw nag-steepen, no? So what's nice there, a while ago I mentioned 2018 where interest rates really shoot up, then following year lower. We saw bond markets, bond funds actually return double digit on the next year. But I'm not saying we will be seeing double digit return for next year, especially if the Fed or even the BSP would hike. But who knows about COVID, no? No one can really tell what would happen, even though we've seen very, very encouraging numbers on the mobility and vaccination rates. But I think with those high interest rates already, especially look at the 10-year, 20-year, they've already reached 5% levels. I think it would be hard-pressed to go higher, push higher pa, no, from that one. So that's kind of constructive for the bond market. What's going to be the risk here is really when BSP could hike aggressively. But as what I've mentioned earlier, we think that they wouldn't hike for the first half of the year, next year. It's really more on the second half. So it's really going to be, let's see what they would do. No? But for this year, it's kind of challenge only because the market's already pricing that in eh. Nag-steepen na. That's why medyo nagbawi yung yield it's getting from the bonds and on the price return.
Dali, Ritchie, medyo simplify lang natin yung mga yung mga terms natin kasi if you just simplify it, medyo nag-steepen, nag-constructive. So what you're actually saying is that medyo tumaas na rates ngayon pero hindi na siya masyadong tataas. So pwede ka so for your bond portfolio, pwede mo nang bilhin. Isa what you're trying to say.
Ayan, sige. So tama. Thanks for rephrasing that. So given that na price in, at least especially on the long end, kumbaga tumaas na this year, and then next year, if ever mag-hike ng rates, we don't think it would really impact, especially on the long end. So kung ganyan, yung prices wouldn't really go down as much. So again, when rates go up, prices go down kasi when it comes to bond investments.
Kasi nga, a lot of insurance companies like yourselves, no, medyo yung 5%, laban na yan di ba? Parang for your insurance funds and for your long-term mutual funds, bibili nyo na yan di ba? Yan na yan.
Correct. Yeah, right? Because yung supply is quite hard to come by and most of the liabilities talagang nasa long. That's why talagang yung 5%, that's kind of sticky, although we've seen it higher before. But that 5% has been there since the start and nakita na tayo ng mga lockdowns, then stricter lockdowns na wala. It's still more or less there, no? Even though nakita na nagre-reopen. So I think that 5% can prove to be kind of a strong ceiling for the meantime.
Okay, good. Salamat for clarifying that. Paano muna kita? I'll let you go first. I'll go to Sem muna. Actually, we're going to ask you about our central bank policy rates kasi nga, we're talking about interest rates, we're talking about the bond market. Gusto namin madinig sa iyo we're managing the largest bond fund in the country, di ba? Pero anong tingin niyo ba dito sa galaw ng mga central banks? You think, are they going to really increase interest rates soon? Later on? Paano ba yung magiging timing niyan? And how will that move now affect our bond investments?
Okay, so we'll first tackle Federal Reserve Chairman. So for the U.S., we think that, they will be moving policy rates. Please note that I'm talking of policy rates here, central bank policy rates and not market rates. Because market rates, as Ritchie already said, has already gone up. But for policy rates itself, we're still steady, close to zero in the U.S. And most likely, the Fed has actually started tapering, which is basically they're buying bonds, like $10 billion worth of U.S. Treasuries. What this does, it keeps interest rates low. That bond tapering or bond purchase program will probably end by June. This was before his recent talk this week, which says that maybe the tapering might even be accelerated. But if he keeps to his original program, he will finish bond purchases by the first half of next year, and so possibly the rising or the hiking of interest rates or policy rates in the U.S. may happen by the second half of next year. May happen. Okay. Now to the Philippines. Could we go to the next slide, please?
So it may happen.
It may happen by the second half, because it doesn't necessarily mean, but the end of bond purchases is also the onset of hiking of interest rates. There normally should be a lag between the two, so you can still see the effect of the end of the tapering program.
Pero Sam, sinabi mo tumaas na rates eh. The market rates tumaas na. Di ba parang anticipate na eh.
Yeah.
Is it already in the price? Tingin mo kaya it's already in the price of the secondary market Itong
Yes.
market natin.
At the beginning of the year, a lot of people were saying, let's say in the US, they were thinking that the 10-year US Treasury move up much to about 1.9, and at some point we actually saw it go all the way up to 1.7, and then some things happened, like lately it was already at 1.5, and then we had this new Omicron variant which brought it down to 1.4 again. But otherwise it would have been closer to what was the forecast at the beginning of the year, which would have brought 10-year US Treasury yields closer to about 1.9. So I would say it was been priced in. A lot of people are really thinking that interest rates should be higher. We've been zero. The US has been at zero for the longest time. And locally, Banco Central rates have been at 2% for the longest time as well. So here, both the central bank and governors, Ben Jokno and Chairman Powell, both have the target of supporting their local economies.
Mm-hmm. Mm-hmm.
And with that, they have to keep interest rates low, if not steady, for as long as possible. So given that, we also believe that the hike in interest rates here in the Philippines will probably happen second half of next year. One thing that the Banco Central can do first is that they can release more reserves for the banks, which would allow the banks to lend more. And with that, we can also likewise support the local economy. So both governors, central bank governors, they have certain tools to exhaust first before they actually touch policy rates. Because the moment they touch policy rates, that's really the start of even more hikes in secondary market yields.
Mm-hmm.
So in both cases, I'll see that they'll probably hike policy rates in the second half of next year.
So teka muna, Sam. You said that hike was already priced in. But you said now na pag nag-hike sila, the secondary market might react again. Tama ba?
Yes.
Might increase again. So how do we manage now our bond portfolio? Mag-short term muna ba tayo? Mag-medium term? Long term? Anong magiging strategy natin dyan?
Yeah. If we could go to that slide that was prepared as well for strategy. Yeah, there we go. Thank you.
Handa ka. Okay.
Yeah. There are actually some strategies that fund managers can do and then higher interest rate in a rising interest rate scenario. First of all is to shorten the duration of the portfolio. That means, do not buy the longest bond out there. Do not buy 20 to 25 years. Stay somewhere in the belly of the curve, and that could be anywhere between 3, 5, or 7-year tenors. It's not always the shortest bond out there, because you have to remember the bond fund has a management fee plus other expenses to cover. So there is some kind of a break-even yield you have to consider. So, but the general direction is to shorten the duration of the portfolio. The second thing that yes.
Yeah. So shorten the duration, meaning yung maturity medyo do sinabi mo kanina 3, 5, 7 years. Okay na yon. Game na yan.
Yeah.
You can get the yield and kumbaga the safety of that bond investment for your medium term.
Yeah. So if I had a maturity today, rather than buy the 20-year FXT, and I might settle for a 3 or 4 year bond for now, and then try to do it in a ladder positioning. In that way, I will have several maturities in the years to come. With that way, I have several maturities to reinvest in the future at higher interest rates.
Good.
That way, I am effectively increasing the portfolio yield in the years to come.
Right. Galing. Good.
And another thing that the fund managers can do is to opt to buy corporate bonds over government securities, because normally the corporate bonds provide a higher yield over GS.
Mhm. So, pero for corporate bonds, these are your local corporate bonds naman you're talking about.
Yes.
Pero more or less the same tenor din. Same tenor. 3 years,
Same
5
tenor, Philippine issued bonds.
Pero Sema, let me just clarify to you. Itong mga nanonood sa atin ngayon, they are mainly stock market investors. And the reason why we're showing these fixed income strategies is that equities is not just, portfolios are not just equities, di ba? Meron din yang fixed income. To your mind, what is the purpose of that? Para saan natin ginagamit yan?
Well, fixed income should always form part of your portfolio. So in the case of probably if you're primarily an equity investor, you need fixed income mostly for liquidity. That's where you park your funds for now, assuming that if the stock market is not doing so well, you opted to get out. Your normal parking facility is somewhere in fixed income. Now, that fixed income can range anywhere from a money market fund to a bond fund, or maybe even a straight bond. There are many options to choose. And so for me, it's a good insurance, shall we say, over when things aren't going so great in the stock market.
Mm-hmm.
Now, it all depends on how much the risk profile of the client is, how much more they would want to put into bonds vis-a-vis an equity portfolio. So, well, we've seen the market hit, was it -3% in one day, 2 days ago? So if things like that rattle some investors, maybe some fixed income would be good to put into your portfolio for a peace of mind.
Peace of mind. And then less volatile naman kasi yan. Less volatile.
That's correct. Of course, fixed income is not as exciting as equities, and it's really more for the long-term investment. But it's more, I would say, if you were to form part of your emergency fund, which is part of your entire portfolio, I would go more for fixed income. Of course, I would consider also taking into account the risk profile of the client, considering the age. If you're more towards retirement already, maybe you shouldn't be taking on too much risk, and therefore putting a little bit more fixed income in your entire portfolio.
Hindi, alam mo, I'd like to ask you na kasi a lot of our audience now are young.
Yes, of course.
They are millennials, mga Gen Zs.
Mm.
And sabi mo, pang parking lang but shouldn't they consider also fixed income?
Yeah. I'm, of course, more biased towards fixed income. And maybe you would want to consider what people call a balanced portfolio. Here in the Philippines, balance would normally mean 50-50 really. But, and with that 50% of your portfolio, you can go there from any duration that you are more comfortable with. For me, that fixed income will be for the long term.
Mm-hmm.
And of course, this is my if I were to do it. And I would be playing around with the other half in the equity market. Let's say, well, it all depends, no? But we've not seen it break beyond 7.1, which was at the beginning of the year. This year, So offhand, I would say I would still go for fixed income.
At times like this, medyo nananalo ka kung fixed income. A certain part
Yeah.
of your portfolio, may fixed income ka, may equities ka rin, di ba?
Yeah, one good thing to have about fixed income as well, especially if you invest in bonds, is that there is some cash flow whenever the coupons come in. So the coupons normally come in every 6 months, unless you bought the RT bond, the recently issued one, which normally pays interest every quarter. So there's that benefit as well of some cash flow if you invest in bonds.
Okay. Sige, good. Sige, salamat Sem. I've been trying to get that from you. But anyway, we have a lot of questions pa.